My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour here is Bill McBride of the Calculated Risk Economics blog. Bill, for those who are not familiar with your background, just introduce yourself to the audience. Who are you? How'd you get involved in the real estate side of things, and what are you doing with Calculated Risk?
Well, Michael, thanks for having me. I have an economics background, an MBA. I started the calculated risk blog in January of 2005, really for two reasons. One is I wanted to figure out what a blog was, but the other reason was I was very concerned about the housing market at that time, as everybody knows now. And so I started off writing about the housing bubble and the possible consequences of it. I've been writing that blog since January 2005, so I guess this is about year 18 or something. And last year, I started a newsletter focused completely on housing economics because once again, I'm a little nervous.
Okay, so we're going to get into that, but first, I want to do a little bit of a history lesson for the audience here, as far as what caused the housing bubble that everyone largely, I think, remembers, and how it peaked in 2006. And then compare that to what's happening here, because you use the word nervous. I think a lot of people are nervous, but the nervousness is maybe different than it was back then.
Well, it's very different. As a matter of fact, one of the things that I've been arguing is that, I mean, it's natural to look back at the housing bubble and think, oh, this is happening again. But the dynamics are completely different. And I've been arguing that really we should be looking back at maybe the 1978, 1981 period for a comparison to today. If we look back at 2005, the lending was absurd. Anybody could get a loan. People joke about ninja loans: no income, no job, no assets. Um, there was the Alt A loans were ridiculous. People could get 1% teaser rates. They would qualify at the 1% teaser rate for 1 or 2 years, and then when it adjusted to the 4 or 5 or 6% natural rate, they couldn't afford the house. And so, when you looked at how much equity people had in their homes, there were a large number of homeowners that had almost no equity or were negative equity even before prices started to decline. If you look at today, that's not the case. People have substantial, anybody that bought 2 years ago or even a year ago has pretty significant equity in their home. They qualified at the actual rate that they're paying, not at some artificial teaser rate. So the lending has been very, very solid compared to what happened in 2005. And there are other real differences too. If you look back at demographics in that period of 2004, 2006, there was no real reason for a big surge in home buying. We didn't have a big demographic group moving into their 30s, say, like we had right now with the millennials moving into their 30s. So we've had favorable demographics this time. We've had solid lending. That's much more like the 1978, 70, 80 period when the baby boomers were moving into the home buying period, and lending was reasonably solid back then. So I think that we need to go compare to that period and not to the bubble.
Okay, now how does affordability analogy? How does affordability back then compare to affordability now? Right, because I think that's sort of where there's a lot of concern around that idea that demographics are what will support an average home trend that's moving higher.
Affordability today, it's much worse than it was, 6 months ago. So, but that's all because of it was a combination. House prices increased, and mortgage rates are up substantially. The only reason that affordability seemed okay during the bubble was because of those ridiculous teaser rates and other lending programs. If you go back to the early 80s, affordability, we had really high mortgage rates. And so affordability would look like it was worse back then. But, one of the things you want to really look at is home payments. If you look at like today versus 6 months ago, payments are up, I don't know, about 50% because mortgage rates have almost doubled. That was similar to what happened in that 78, 80 period. very quick increase in mortgage rates, even though mortgage rates were much higher back in that period and went into double digits. Um, it's the change in mortgage rate payments that really affects the housing market, and we saw a similar increase in mortgage payments from say 78 to 80 as we did from last year till right now. So that's what the one thing I would be looking at is how much payments have increased, and you know, meanwhile, house prices have still moved up a little.
Which is, I think, really interesting because there's this kind of timing disconnect, I think, that's taken place in a lot of different asset markets. You look at where housing is, to your point, prices are still staying elevated against the backdrop of collapsed equity markets, collapsed bond markets, and soaring mortgage rates. And mortgage rate volatility is obviously quite high as well here. And by the way, Bill, I don't know if it was on my end, but it seemed like it was a little bit in and out. I don't know if it's the connection on your end or not. Just we'll see how it goes here. But let's talk about that speed of mortgage rates here for a moment. Historically, where does the increase in mortgage rates in terms of that speed really become a problem? Is there a concern that mortgage rates have risen too far too fast? Is there a concern that causes a very sudden and abrupt slowdown? Talk about that velocity of cost of capital for a moment.
Well, like any market, everything moves at the margin. So, this fairly rapid, well, very rapid increase in mortgage rates has taken a number of people out of the mortgage market or out of the housing market. So that doesn't mean that other people won't be buying. As a matter of fact, surprisingly, at least surprisingly to me, houses are still moving fairly quickly. And we're not seeing all of a sudden a complete stop in the housing market. So even though, and that's because there's a lot of people that can either afford the new mortgage payments or they're paying cash. So um, when I look at how quickly mortgage rates have increased, that's what I look at is how much sales have dropped. We saw in the existing home sales report that sales were down to about an annual rate of 5.1 million. We were at 6 million, not long ago. So that's the kind of thing that we're going to see. It's not like it's going to go to zero. It's just going to drop 20-30% in sales.
All right. So and now I've seen you put these tweets out as well, Bill, about this. Seemingly, it looks like a lot of home sales are suddenly getting canceled. And there's a lot of anecdotes around that, and the anecdotes are obviously very different than real data. But what are some of the things that you're seeing in terms of the way home sales are suddenly sort of responding to mortgage rates here? And is that the start of a larger trend, you think?
Well, the thing I like to focus on is inventory, even though the mortgage rates hit demand. Demand is always a little hard to measure. Hopefully, I'm real near my Wi-Fi now, so hopefully the connection's better. Um, and one of the things that I'm watching is to see if, I mean, inventory is picking up, but it's still pretty low historically, and so it's not like we're being flooded with inventory. So one of the things I'm looking at right now is to see if we get a lot of new listings, a big pickup in new listings, and we are seeing that in a few markets: Phoenix, Boise, Austin, all seeing a pickup, a sharp pickup in new listings, which to me means people are kind of going, "Hey, I want to get out." Um, and that may be, and some of those markets had some speculation. I don't think we had widespread speculation, but I think Phoenix had a number of investors trying to speculate a little bit. So, when that's the number one thing I'm focused on right now is how much inventory increases. If we look back at 2005, in the second half of the year, inventory just increased rapidly, and that was pretty much the sign that housing bubble was done. Here, I don't expect to see that kind of increase in inventory. So that would suggest that, prices won't be falling significantly. As a matter of fact, I right now on a national basis, I'm not even forecasting a decline in house prices. I do think we'll see some regional declines.
Okay, so I find that interesting. You're saying you're not forecasting sort of an outright decline on a national basis, but that some individual markets obviously might have some declines here. Let's talk about the sort of uniformity for a moment, because yeah, I think as I recall, in the midst of the some of these markets. So let's continue with this point that you said that you don't necessarily forecast a sort of a broad based decline in housing, but obviously some individual markets will have their own decelerations or depreciations. When you look across the national landscape of housing and you look at some of these individual local housing spots that have been quite hot, how does that variability around the average of individual markets compare to other very hot times for housing? In other words, in the midst of the '04 to '06 housing boom, you had some clear runaway markets. It's not clear to me if you have a similar sort of runaway in some markets today like you had back then, but let's talk about some of those dynamics in terms of the average.
In the 2004 2006 period, we kind of joked that the sand states were crazy. You know, obviously California, Nevada, Arizona was insane, Florida. So there were some real regional issues, and those are the areas that saw the biggest price declines. This time, there have been some specially hot markets. I think a lot of people focus on Boise. Phoenix is another example, but it wasn't. This was more widespread price increases, and I think it's because it was driven by different dynamics, both somewhat positive demographics, and of course, very low mortgage rates.
Very good. So we touched on a little bit of this sort of differentials in terms of the average versus hot markets. What is it? So again, let's go back to the word that you used earlier, that you're nervous about things. You're nervous, but it doesn't sound like you're overly nervous because you're not thinking that prices really outright decline. If you're not worried about sort of a broad based period of weakness in housing, why is it that you're nervous? What is it that concerns you?
Well, I didn't say wasn't concerned about weakness in housing. Um, you know, I think if we take a step back, the the Fed is raising rates because of inflation. The primary transmission mechanism for Fed policy is housing, and so what I'm concerned about with housing more is that the housing industry is going to be under pressure for some time, as long as the Fed needs to raise rates or keep rates up. So that's more of a concern. As far as falling house prices, back in 2005, I was really worried I was absolutely certain prices were going to fall. As a matter of fact, people made fun of me when I said some markets would fall 40%. But I had an additional concern is that could lead into a deep recession and a financial crisis, which is unfortunately what happened. That this time, even if we get price declines in some areas, and if we see uh, national prices fall to zero, which is what I expect, just completely stall out, that does mean there will be regional areas that decline. But that won't lead to one. It won't lead to cascading price declines because we're not going to have all these forced sales that we had back after the bubble. And two, that means that there won't be a financial crisis kind of situation that follows any declines in house prices. So I'm not nervous about that. But for the housing industry, I feel like they're going to be under pressure for as long as the Fed needs to work to get interest rates or inflation down. Yeah, investor buying is an issue this time around, and there's all kinds of different investors. I one of the things is just they're not sellers. They're not, some of the investors are, but in general, I don't think the investors are sellers. So I'm not that worried about them pushing down prices, and trying to get out. They're not forced sellers. They're leasing out the houses or whatever. So the that doesn't concern me. I do have kind of a general concern that investors have bought up a lot of the starter homes, and that I think is a bad dynamic for the housing market in general, but that's more of a overall concern. That's not an economic concern in the short term.
And is that sort of a relatively new phenomenon when you look across the history of housing, that you've had so much more investor activity in housing?
Yeah, it really started probably 2009, 2010. Where there were so many distress sales, so many houses were selling at ridiculously low prices at foreclosure sales, that really attracted a lot of investors. And then I think people have realized, hey, this is a pretty good investment. So I think the level of investment it's in single family is much higher than it used to be. And I'm not sure that's good for the economy long term. I'm kind of in the camp that buying a house is pretty good for the middle class. So and that limiting people from buying is I think a long term problem, but I don't think it's something we need to worry about short term.
But if and I agree on that point, but if it becomes a larger and larger percentage of purchases, to your point about resulting in sort of non-forced sellers, that could prolong a housing bear market to the extent that we might have one, because you're not going to get that kind of real clearing type of situation, because institutions, to your point, can simply wait it out.
Yeah, well, historically, okay, you take housing is a boom bust industry. It's been that way forever. It's hard to explain to people during a frenzy that there's going to be a time when you go to open houses and you'll be the only one that ever shows up that day. And the flip is also hard to explain. I remember a few years ago talking to an agent. I was the only one that walked in that house that whole day. And she goes, gosh, I don't know if we're ever going to get people, walking through the house again. Well, now if they had that open house, or at least 6 months ago, they would have had, 50 people and 5 offers. People, you have to remember it's just a boom bust industry. And that's not even counting the housing bubble. I mean, it's just naturally, it goes through these cycles. And so, right now we're probably entering somewhat of a slowdown. I expect it to be kind of like a bus cycle, more of a normal bus cycle, and that means that there'll be an extended period, to your point, where house prices won't go up. As a matter of fact, I my initial guess would be, in real terms, of course, that just economic nerds do things in real terms, but in real terms, we're probably not going to see the same prices that whatever we peak at this year for maybe 6 or 7 years. It'll just go down a little or flat in real terms, and and that and but that's how typically the housing market adjusts when it gets a little ahead of itself. And then that brings down the price to income, and it brings down the price to rent, and all those ratios that we use to kind of evaluate how far out of line we are, they'll all come back towards normal.
So that's an interesting idea. And so if we go with that idea for a moment here, that housing flatlines, well, probably won't. What will not flatline is unemployment, right? In other words, you'd probably see incomes broadly drop and unemployment increase. So it sounds to me like that's actually a recipe for affordability to even get worse, because the income side and the employment side actually counters that hope that home prices would become, on a relative basis, a better buy.
Well, and that's a possible short-term thing, but I was talking about over 6 or 7 years. Incomes will be way
Yeah,
up
sure,
six or
sure.
7 years from now. So I mean, they won't decline. I mean, if there is a recession, it's that's a next year thing, and job losses could lead to further price declines in housing. There's no question, because that could be a forced sale issue. So that's kind of a different. That's an additional dynamic to what we're seeing. I always step back and say a lot depends on inflation and how long the Fed has to be aggressive on inflation, um, because housing is really going to take the brunt of it this time. Usually auto sales take a pretty good hit too, but this time auto sales aren't. They've been depressed by supply constraints, and they're just not going to fall that much just because the interest rates went up a little. So I think housing is just going to really take the brunt.
All right, before I go to the audience here, there's something that's been bothering me about some of these narratives around housing and this idea that there's this kind of structural shortage that's out there. And I've made this point before, and I know you've done a lot of work on this as well. That there's differing opinions around how many homes are short. I saw one estimate that's around 3 million homes, and I push back on this narrative that that's a supporting aspect of housing because against that backdrop of whatever number we agree on, housing is short by, the number of second homes is something like 10 million. And I get it; it's not exactly a fair comparison because of different locations, but this and it kind of goes back to that earlier point that you've had this tremendous move of investor behavior viewing homes as an income producing asset as opposed to a place that you necessarily live in. But it seems to me that the housing shortage is a little bit of a mirage because people are simply buying up second and third homes and then effectively Airbnb-ing them or renting them out.
Yeah, I mean that's what they're kind of talking about. But the idea of a housing shortage is really based. The question is what price? If the price was half of what it is today, there would be a huge housing shortage because there'd be a lot more demand. If the prices go up, there's less demand. If there are always households that are doubled up, and so there are people unfortunately living in their cars or whatever. But it's really hard to put a number on where we should be on the number of houses. So I've seen those estimates. I've seen the Zelman Associates analysis that shows we don't really have a housing shortage. I would probably say I'm much closer to Ivy Zelman than I am to say Freddie Mac's estimate. We're the okay. We have inflation for a number of reasons. The Fed's raising rates to fight to try to slow inflation down. Uh, we are already seeing some significant price declines in certain aspects, like lumber is well off from its peak. I think it's in the $500 per thousand board feet now. It was at $1,600 or $1,700 per board feet when it peaked. So I mean that's a third of the price, but it's still well up from 2019 prices. So it's there are a lot of dynamics moving. It's much less expensive to frame a house today than it was 6 months ago. Um, and that's because there's less demand on starting homes. Now there's still a record number of housing units under construction, so we're not going to see an employment hit because that's where the employment comes from. So I think if I understood your question is the how much does the inflation push up the cost of the house? And I think that we've already seen that, and that now we're actually seeing some of the costs coming down from the builders I talked to.
By the way, I'm glad lumber's being mentioned. I shared at the top of the nest a picture of a bunch of lumber that I just took and said jokingly, I found me some gold. What's in my Twitter picture is lumber and gold, and the whole reason is because of that link to housing. It's always funny to me on Twitter when people say, "Why the hell do you focus on lumber so much?" while they're tweeting from their house, when the average house has around no, really, when the average house has around 16,000 board feet of lumber. There's a very high correlation between housing starts data and price movement in lumber. And I've argued for a while that if you really want to get a real time sense of housing expectations, you don't do it from Zillow. You do it from LBS1, which is the continuous contract on lumber futures.
Well, the basis for that view on house prices is just historical. That's typically what happens after we get a big run up in house prices. We get a period where real prices decline and don't get back to that peak for 5, 7, 10 years. And we've seen that over and over and over again. So that's based on more of a historical analysis. As far as the Fed and inflation, this is a very complicated cause and effect situation. When we look at inflation, there's a number of reasons we've had a surge in inflation. Some of them are pandemic related. More recently, some is related to Ukraine, and so there are a number of reasons, and we're seeing we're also seeing that inflation worldwide. So So it's not just a U.S. phenomenon. And one of the things that we saw, of course, during the pandemic was a shift from services to goods. At the same time, people were able to maintain their incomes, a large part because of fiscal policy. And so there was a natural surge in goods prices, and we're seeing a switch back to services, but not quite pre-pandemic levels yet. Yeah. So we still have a ways to go. So the Fed's kind of fighting a problem. A lot of it they can't really control. So that's why we don't really know how long they're going to have to raise rates or keep rates elevated.
Well, and by the way, and Emma, to your point on that, I've made this argument many times. The Fed, the history of the Fed proves that everything they do is ultimately about re-leveraging, and that re-leveraging following a crisis creates higher leverage, which creates more fragility, which creates a bigger crash, which creates more re-leveraging. So you end up having these sort of 1 in 1,000 year events happening almost every year, because you're re-leveraging, never solving the problem, and that re-leveraging creates a lot more potential black swan type of setups, so to speak. Well, but actually, that's a good direction, because I think that's there is that narrative out there, Bill, that which I think is largely true, that housing is essentially an inflation hedge, and I think there have been some studies by Schiller that have argued that historically, on average, housing is really just something that keeps up with inflation, doesn't necessarily get you real investment returns, beyond inflation. But let's kind of go with that. That idea that housing is sort of the way to protect against inflation, if indeed inflation is on a sustainable basis going to be moving higher.
Well. First, let me say I'm definitely an optimist. So
you calculate risk is what it is. That's why you're an optimist.
Yeah, I don't subscribe to the fact that that there's going to be some sort of huge financial reckoning based on Fed policy. So I just don't see that. And
you're in a minority, and I see people dropping off the space. No, I'm just saying that.
But I mean, let me take a step back and say, when I started my blog in January 2005, I was very bearish on housing, and I in the beginning of 2007, I said, okay, it's going to take us into a recession, possibly even a financial crisis. In January 2009, I wrote a post titled "Looking for the Sun." And you should see, talking about people dropping off, you should have seen all the angry emails I got. What are you talking about? We're going into a major depression. And I was pointing out the fact that there's a number of indicators. Housing was still in trouble, but there was a number of indicators that showed we were nearing the bottom. And when I remember in March, when you turned on CNBC and the market was crashing, and every talking head from Jim Cramer on was talking about the coming depression. And I had been writing for 3 months about how it wasn't going to happen. So I was like, okay, those guys are all wrong. So I really am an optimist, even when so if it sounds like I'm negative on housing right now, I am a little, but I'm not a big pessimist on the overall economy. Oh, and I was, I wrote in 2015. I had to wear sunglasses. The future was so bright. I even wrote that after Trump got elected. I said we're still okay.
Well, but by the way, and I want to go to the other audience also, because I have quite a few people that want to ask questions. I'm glad you mentioned that, Bill, because I think this is something I keep stressing about the future, which is that no one knows what the hell tomorrow brings, and people do get sucked into narratives, me included, by the way. I mean, that's human nature, right? But the reality is, I keep using that line, right? Opportunity always exists when the crowd thinks it knows an unknowable future, right? And contrarianism isn't about just being optimistic for the sake of being optimistic. It's that where's where's the expected value higher.
One of the mysteries here is typically, if you get a surge in home buying because of low mortgage rates, we had a good demographic moving into the home buying age. Well, that's good and great. We expected to see some pickup in home buying in the 20s, and it started, and then of course the mortgage rates accelerated it. But why did rents soar? And that's been I've been calling this the household mystery, and there's been some interesting research lately that shows areas. This is there was I forget who did this research, but it shows the areas that had the most work from home also saw the largest increases in both rentals and in home buying. And so, why would that be? Well, my theory is that people, if two roommates were living together and they both start working from home, they get kind of tired of each other, and they go out and form new households. And so one of the questions that we're trying to figure out right now is, why was there such a surge in household formation over the last year, even though there was no population growth? And that, some of it is young people moving out of their parents' house. Some's roommates splitting up. Some is older people getting divorced, which we know divorces picked up significantly last year. So this is what drove the rentals and the rental prices. But that seems to be pretty much a one-time surge in household formation. And so I very much expect, and we're starting to actually see some evidence of this, that the rent increases are going to slow, and probably slow pretty sharply. And when I say there's evidence of this, the National Multi-Housing Council this week came out with their quarterly survey showing how tight markets are. And basically, that's been showing markets have been incredibly tight for the last year. And this survey this year showed neutral. And so that is a real good leading indicator that we're going to see a real slowdown in rent increases. At the same time, we're also going to see we've had an enormous backlog of multifamily under construction, the most since the baby boomers hit. So this is a big number of housing units that are going to hit the market pretty soon. And that's also going to really help with rents. So I think it's a great question. And I think the rent surge is probably going to slow way down.
By the way, everybody that's in the space, make sure you follow Bill McBride here, not only on Twitter, but also obviously his blog. He's got some phenomenal research, which I think is unequivocally worth paying attention to.
Well, thanks for reading all these years. Yeah. Well, first of all, yes, I live in Orange County, and I rarely mention Orange County. The reason is I don't have good access to data here, not because of any other reason. But Orange County has has been just as crazy as say San Diego or any other of the crazy areas. So, I think the dynamics will be very similar to what we see, whatever happens in San Diego.
I love that. I love that point because it does go back to that. I don't know if you were here in the beginning of the conversation, but I mentioned that point that I'm not of the opinion personally of this idea that there's a real shortage, exactly because of that point, the Airbnb verbodization, if that's a word, so to speak. But Bill, I'm curious to hear your thoughts. I know you focus more on the U.S. side, but let's Canada's sort of the problem child, right?
I do. First, I don't focus on Canada at all, but I understand what he's talking about. But when the builders talk about supply constraints, they're definitely not talking about the same thing that you're talking about. What they're talking about is their ability to get parts to finish houses, whether it's a garage door at the end or windows. Typically a window vendor might quote 6 to 8 weeks. Recently, or at least at the end of last year, they were quoting 6 to 8 months. So that's what they're talking about and a lot of builders didn't want to sell their homes until they were framed because they didn't really have a handle on prices. So, when you hear the builders talk about supply constraints, they're not talking about end supply like you are. You're talking about supply to the market. They're talking about trying to build the house, which is a completely different topic. I appreciate what you're saying about the investors, and I do share some of your concern about investors. When somebody buys houses, multiple condos, and then rents them out, whether it's Airbnb or long-term leases, that there are people occupying those. If the number of households renting falls, then those people might get in trouble. A lot depends on how the quality of the borrowing that they did. If it's if they're highly leveraged, then that would be a risk. If they're not, which everything I've looked at says those people, at least in the U.S., are not highly leveraged. So they've for investors, there's a requirements for a lot more down than there is for a
Just
homeowner. Yeah, first, it's more the administration and the Congress in the U.S. that is focused on getting more housing supply to the middle class. Say, that's not the Fed's focus at all. So, and as I mentioned earlier, unfortunately, the primary transmission mechanism for Fed policy is housing. It just the most interest rate sensitive part of the economy. That's where you see the Fed policy show up. It's not like they're targeting housing. It's just that that's the way it works.
but they themselves also had said that, I think, in '07. I remember Bernanke was basically arguing, and there's been papers on this as well, that when you talk about the wealth effect, that's really the housing effect. It's not the stock market effect.
Well, wealth effect is both, but yeah, I mean, you know, it, higher rates do impact other assets too, of course, because when you raise the rates, now people have, they have a choice between, buying, say, a 10-year treasury and stocks, when the 10-year was yielding, nothing, that choice kind of pushed people to stocks, right? Now that it yields close to 3%, some people may find that more attractive. And so and that's just an example. So, but the real slowdown is always in housing, and that's where we're seeing the slowdown right now. Will we get to back in the 80s, some of the home builders were mailing 2x4s to the Fed, pleading for them to lower rates, because they weren't building any houses at all. I don't think we're going to get to that. 2x4s are too expensive today. Nobody's going to mail them. But that I guess my point is the Fed is not targeting housing. Fed, it's not like they care about housing policy one way or the other. Not that they don't care. It's just that's not their mandate. So they're focused on inflation and they're focused on employment. And those are the two mandates for the Fed. Well, let me say this: a pause in September is possible. I think it's probably a low probability, but it's definitely possible. We are, as you're pointing out, seeing a lot of commodities falling now in price. But there are components to the inflation, especially, about a third of CPI is owner's equivalent rent or rent of a primary residence. And those are still going to go up over the next 6 months. And so we're still going to see some pretty high inflation numbers for a while, even if inflation is starting to slow in some areas. So, I think a pause is possible, but unlikely in September. But it definitely could happen. But I think if you look back at the Volcker Fed, when they were hammering inflation back in, say, 1980, 81, they cared about employment too. But the unemployment rate was over 10%. Probably most of the listeners don't remember, but in Reagan's first 2 years, the economy was in the worst situation at that time since the Great Depression. You drive around and there were homeless camps everywhere. There, Reaganville signs, just as a play on Hooverville. And when they got inflation down, things just really took off. And then in the next 2 years, it was morning in America. So I don't see it playing out the way that you're saying at all. The pause in September is possible, but we definitely don't see hyperinflation, because we actually understand hyperinflation pretty well, and we're not set up for that at all. So I'm just not that pessimistic on it. But if the economy really starts to slow and we start seeing unemployment click up, the Fed could definitely pause. There's no question about that. Yeah, I love your question, and thanks for reading. And by the way, I put all that data and charts out there so everybody can make up their own mind too. So don't just listen to what I say. But this is an interesting question, and it may become a big debate point later this year. is if CPI is being primarily driven by OER, and people were saying, well, OER is actually actually happening, and the Fed may come under a lot of criticism for that exact reason that you're mentioning. They may be raising rates based on, they mostly follow PCE, but if they may be raising rates based on inflation numbers that are coming out that are actually lagged. I don't really have a good sense for how long. Or what the lag is for OER. That's something that I really need to look into. But it's obviously, that we saw the rents really take off in some of the private surveys last year, and then OER just really just started picking up earlier this year. So it looks like it's a 6-month lag or something. So that could be a big debate point later this year. Yeah, so that's, I mean, it's a great point, and it could become a real issue later.
One thing, unfortunately, that is an issue is that we have to end the space here. So that's here. Again, please make sure you follow Bill McBride. I apologize. It looks like the problem was on my end earlier in the conversation, but I appreciate those that stuck around, that engaged, asking questions. I'm going to have a number of spaces this week, almost 2 or 3 every single day, because I am a glutton for punishment. Thank you, Bill, for
Well,
joining.
thanks for having me.
Yeah, no, this was a great conversation. Thank you everyone for joining, and enjoy the rest of your Sunday. Thank you, Bill.
Yeah, thank you, Michael, and thanks to everybody. Talk to you later. Bye.
Thank you, everybody. Cheers.